The study of tanks has brought up the idea of expected value, which is a central idea in the other risky business of buying and selling insurance. So insurance is a way of tempering the vagaries of a risky life, and the whole concept of insurance is based on statistics. We can view insurance as a game of chance, where we determine the value of insurance as the expected value of the return. But of course, our decision to buy insurance or an extended warranty on a product or health insurance are based on a lot of other issues besides just the expected value of the return. It's a method by which we can make sure that our risk is not, we're not going to suffer great calamities. But the problem with insurance is that insurance always involves large numbers and scarce events, which people are not good at gauging in an even-handed way. And it makes it difficult for us to evaluate issues about insurance. For example, how much is an appropriate amount for an insurance policy to charge? Let's look at an insurance company that is insuring us against choosing the queen of spades from a deck of cards. So suppose that we have a deck of cards and the insurance policy is the following, that people are going to take this deck of cards and choose a card. If they choose the queen of spades, then the insurance company has to pay them $100. See, very simple insurance. The question is, how much money should the insurance company have on hand to know that it can pay off all the possible claims, and also how much should it charge for the insurance in order to make money on its as an insurance company? Well, our strategy is that we look at the distribution of possible numbers of winners out of these 1,000 players. It's possible that no one will choose the queen of spades. But it's possible that in fact all 1,000 people will choose the queen of spades. Well, in which case the insurance company goes broke. But the point is that we can look at the distribution of the likelihoods of 1,000 people, of how many out of those 1,000 are likely to choose the queen of spades. It's going to be centered at about 1/52nd of 1,000, because there are 52 cards in the deck, and you have one, each player of the 1,000 has a 1 out of 52 chance of picking it. But we can see this distribution that shows us that, generally speaking, the number of people likely to choose the queen of spades will vary between about 10 and 30. So if we want to be 98.7% sure of staying in business, we can have our insurance company have enough money on hand and charge high enough premiums so that it can pay the claims for 29 or fewer winners, because that's how many winners being the people that you have to pay off. That will account for 98.7% of the time. When buying insurance about products, for example, extended warranties, when you go into a company and you buy an electronics item, they'll always try to sell you an extended warranty. In that case, it's important not only to know the average time to failure of your electronic device, but in fact the distribution of those times to failure. And let me just show you a chart. Suppose that this is the chart of the time to failure of some electronic device that you're buying. And you're trying to decide, should I buy the extended warranty? Well, the advertisement will say on average, the time to failure is right here. And so you should buy the extended warranty. But in fact, the distribution of times to failure may look more like this graph, in which case, this is the likely location of the two important moments. One is the end of the manufacturer's warranty, which is when things fail because of some manufacturing defect. Then once an electronic item is going, it works pretty well for a while. And then right about here will be the end of the extended warranty period, at which time a lot of these devices will break. At least this is the common experience of many people in trying to decide whether or not to to buy the extended warranty.